Hello, and welcome to this special look at inventory management in the supply chain. My name is Brian Strait. I'm editor in chief of Supply Chain Management Review magazine, and I'm honored to be hosting this session today. Before we get going, let me do a few housekeeping items. At first, I'd like to thank our sponsors for today's event, Blue Yonder, Coupa, Envista, and RFgen, for helping us put on this event for you today. There are additional resources that will be available to you. You can download those from your dashboard during the course of this event, so please take advantage of that opportunity as well. There's some great information in there that I know you guys will learn a lot from and will help you in your businesses. And now onto our content for today. Monthly and quarterly inventory reports tend to group all categories together to achieve an easily digestible trend item. Inventories are up, inventories are down. What should we do? Well, one trend line doesn't always tell the full story of what is happening within the supply chain. If you're a frequent reader of LinkedIn content, you've likely come across our speaker's insights at some point, and you may even follow him yourself. Jason Miller is the Eli Broad Endowed Professor of Supply Chain Management and interim chairperson of the Department of Supply Chain Management within Michigan State University's Eli Broad College of Business. I think he does a fabulous job of breaking down inventory data and putting it into context. I've been following him on LinkedIn. I enjoy it greatly. So I'm very pleased that he's agreed to join us today and share some of his insights on what's happened in inventories this year and what 2025 may be looking like. Finally, before I turn it over to Jason for the presentation, I just want to let the audience know that he will be making a PDF of today's slides available for download. So you can download those at the end of the presentation along with some of the sponsors' resources. So I thank you very much for that. At this point, I'd like to welcome Jason Miller. Jason, the floor is yours.
Hey, Brian, thank you so much for that introduction. Welcome, everybody. And let's talk a little bit about where inventories are at right now at various tiers of the supply chain and in various industry sectors. And what I want to open with is a real quick clarification of a very important distinction that needs to be made between two ideas that exist in understanding the behavior of inventories. And that is the difference between something that is called the Inventory Accelerator that isn't as recognized in industry versus something that is recognized by everybody in supply chain, and that is what's called the Bullwhip Effect. But I actually find tends to be very misunderstood with what that concept actually means. I bring up this distinction because so much of what we've observed since 2019 is not actually the bullwhip effect. It's much more this inventory accelerator idea. And I want to explain that real quick before we get into the conversation about what is going on in different industry verticals. And so with that, the bullwhip effect, which I want to start with first, that is actually defined as the idea that the variance in orders tend to become more amplified as we move upstream in the supply chain from retailer to wholesaler, wholesaler to original equipment manufacturer, finished goods manufacturer to tier one supplier, etc. And so the classic example of the bullwhip effect, and this is taken from Howley and colleagues' 1997 article in Sloan Management Review, is the idea that you have consumer sales of some product where sales tend to be very steady. So think something like diapers as an example. And what happens here is in the middle of the time period, you have a little bit of a spike. Well, what ends up happening, though, is that retailer's orders on the top right to the tier upstream. Now, I know the diagram says manufacturer, but this was really meant to say wholesaler. You'll notice those orders are more volatile. Well, if we then look in the southwest quadrant, the wholesaler's orders to the manufacturer, they're even more volatile. And then the manufacturer's orders to the supplier become even more volatile on top of that in this classic scenario that's often called the beer game. But the key idea with the bullwhip effect is demand for that final good is what we would call stationary, meaning for all intensive purposes, it has a fairly constant mean and a constant variance. The challenge, though, is that what we've experienced over the last 5 years is not actually nearly as much this phenomena as something else, which is called the Inventory Accelerator, which is a principle that has existed for many more years, ironically enough. The Bullwhip Effect was identified in the 1950s. The Inventory Accelerator was identified as far back as 1917, but really articulated in the 1940s. So this is quoting from an article that I co-authored in Supply Chain Management Review with my friend and colleague Jem Bolyamola at the University of Tennessee. But the idea for the Inventory Accelerator is that a firm's level of inventory is positively correlated with its level of demand. So if a firm sees a big increase in demand, they end up having to also adjust their inventory level upwards. And conversely, when demand drops, inventory levels adjust downwards. And this can be understood just based on simple rules for inventory control. Take the EOQ as an example. Your order quantity increases as demand goes up, but at a less than linear rate. The same idea applies with safety inventories. Is if you're calculating safety inventory using something like the standard inventory theoretic approach, as your demand increases, your amount of safety stock will increase. And so this is a key idea to understand what we're going to be talking about through the rest of this webinar as we look at the behavior of inventories in different industries. And so with that, just to give an example of an industry that clearly shows this idea of the Inventory Accelerator, what I've picked here is machinery wholesaling. That may be a sector you don't think much about, but this is a over $50 billion a month industry right now. So this is a very large sector of wholesaling. This is companies that sell, wholesale skid steers and construction equipment and any type of industrial equipment, agricultural equipment, et cetera. And what I've done here is taken data from the Bureau of Economic Analysis, and I've plotted data for inflation-adjusted sales in black and then inflation-adjusted inventories in red. And what we can see here is if you go back to 2017, sales are rising really rapidly from 2017 through 2018. If you notice at the same time period, inventories are also increasing. So when you think about what that means for machinery manufacturers, the wholesalers are experiencing more demand, and they're not only selling more, but they're also increasing their inventories. So the manufacturers are seeing a double benefit because the replenishment orders are exceeding the sales at the wholesale level. But then you'll notice in 2019, sales start dropping, and soon afterwards, inventories start declining. You think what that means? That means manufacturers are essentially being double punished. Not only are wholesalers selling less, but they're drawing down their inventories. And if they're doing that, that means replenishment orders have declined more than what sales declined. So you go into the pandemic, of course, we have the shutdown. And then on the other side, machinery sales start to pick up really rapidly. But it took a while for machinery manufacturing to turn back on. So inventories keep dropping. These sales keep going up through 2021 as we have a commodity market boom, a strong expansion of fracking, very strong housing construction, very strong warehousing construction. So we have this tremendous amount of demand for machinery. So sales keep going up, inventories keep getting drawn down. But then by 2022, even though we start to see sales go up, still we start to see inventories increase even more rapidly. Well, the challenge now is sales started to fall very sharply in 23, but inventories kept going up. So in other words, inventories start to overshoot. And what you're noticing now is finally inventories have peaked right as demand seems to be coming a little bit off of a trough. But given right now that the amount of inventory relative to sales is essentially unbalanced, we have too much inventory, we're going to need further drawdowns in this sector. That is the quintessential example of what the Inventory Accelerator represents. Now, I bring this up because as we talk through these next slides, this is a pattern that repeats itself in industry after industry that we observed on the other side of the pandemic. And so just to sort of start us off, let's take a sector that saw a huge surge of sales with the onset of the pandemic, and that was brick-and-mortar retailers for furniture, furnishings, appliances, and electronic products. So on the left, what I have is inflation-adjusted sales relative to 2019, which you can see as an example is by 2021, these brick and mortar retailers are selling 15% more goods than what they were before the pandemic. You can see on the right in the ratio of their inventories to sales that this ratio fell very sharply. Historically, anytime you see an industry show a sharp drop in their ratio of inventories to sales, that suggests that we've seen a very sort of unforecasted increase in demand. But then you'll notice by 2022, in the middle part of the year, that ratio of inventories to sales actually rises above pre-COVID levels, and then it starts to drop down. What that's telling you, because sales have been flat to down from 21, is this is showing that inventories have actually dropped on inflation-adjusted terms, and that's what we see in the data, not shown here, but that I've looked at elsewhere. So notice that pattern and keep that in mind to understand the current dynamics we're experiencing. You'll also see this sort of gravitational pull back to inventories to sales ratios towards pre-COVID levels. This is going to be a theme of what I'm observing in the data. So take another example, building material retailers. So companies like Lowe's and Home Depot. You can look on the left and you see this absolutely tremendous spike that occurs initially. That is May of 2020, when inflation-adjusted sales spiked 15% beyond where they were at in 2019. You can see on the right that the ratio of inventories to sales plunges. What that's telling you is this super strong demand realization caught the building material retailers off guard. I don't think anybody thought, going into the pandemic, with people being locked at home, they were going to start building decks, buying grills, all of this stuff. And you'll see sales remain very, very, very elevated. There's these other big spikes in March and April of 2021 corresponding to stimulus. But then they start to cool down as the housing sector starts to slow, especially in 22 into 23. And basically now our sales are back to sort of where the pre-COVID trend line put us. You can see inventories though. Notice again, we have this sharp rise in inventories to sales in 22. That has persistently remained elevated. So what that's telling you is these building material retailers actually are sitting on more stock today than we would really expect. So their amount of inventory on the books, even adjusted for inflation, is still about 15 to 20% above pre-COVID levels. So their warehouses and stores are still quite full. If we look at clothing retailers, this really matters from, let's say, an air freight standpoint, given the high dollar value nature of a lot of apparel. Sales absolutely were devastated with the pandemic. I have to truncate the plot, otherwise we couldn't see anything. But then notice on the other side, in 2021, specifically corresponding to the March 2021 stimulus combined with widespread vaccinations, sales bump up 15% above 2019 levels. And all of a sudden, their inventories to sales in the right plunge. So again, this is an unexpected realization of demand. Well, the clothing retailers were very disciplined, and you'll notice their inventories to sales have climbed back right to where they were before the pandemic, but they're not increasing anymore. So this was a sector that did not have this excess inventory accumulation issue compared to the furniture and appliance retailers or the building material retailers. Department stores, so this is your Kohl's, your JCPenney's, your Macy's. Sales were in a big secular downward trend before the pandemic. Of course, they fell very sharply. Then actually they rebounded very strongly. And while they've fallen from those 2021 levels, they're actually doing much better than where the pre-COVID trend line put us at. No, inventories to sales, you can see a little bit that these retailers got over inventoried in 2022. It wasn't that bad though, and they've since adjusted inventory levels back to where that ratio is right to where it was before the pandemic. Again, talking about sort of this center of gravity issue that we observe. Then for the other general merchandisers, this is your Walmarts, your Targets, your Costco's, etc. In comparison, you see that sector saw these big surges of demand in March of 2020. That's the everybody runs out and stockpiles everything they possibly can with shutdowns. Then these big bumps in January of 21, March and April of 21, that's stimulus money. Sharp fall in 23, and then we're now back to just following that trend line straight upwards. That ratio of inventories to sales, now this is the one series so far that is not published. I've had to back into these data. You can do that with the different government releases. But if we look at the ratio of inventories to sales, it really rose in 22. This is that time period when Walmart and Target built up far too much inventory. But they've since brought that ratio back again to 2019 levels. So if you think about it, we're entering this holiday period with inventories relative to sales for these retailers right in line with essentially expectations where you would think they would be. And then as we move further upstream in the supply chain into the wholesaling space. So wholesale trade does not get the attention retail trade does in government data releases, even though from an industry classification standpoint, wholesale trade is critical for freight volumes. And what we observe here, for example, for the furniture wholesalers, huge explosion of sales on the other side of the pandemic. People are moving houses, people are buying new furniture. But subsequently, sales have actually fallen to where they're 10% below pre-COVID levels. A lot of this is due to the fact that existing home sales are down as people are locked in with low mortgage rates. We've seen these wholesalers bring down their inventory to sales ratios from the highs in 22, but they're actually still elevated. So again, this is speaking to a sector that's actually a little over provisioned right now when it comes to inventory. If we then look at professional equipment wholesaling, this is sellers of computers and all types of professional equipment and whatnot. You can see very strong sales on the other side of the pandemic, especially in 2021 into 2022. Kind of this dip down in 22 through 23 and now a little bit of a rebound. A lot of this is likely due to the AI computing boom, creating demand for things like servers and whatnot. This is a sector that is a big user of air freight. And what you can see here is that right now their inventories relative to sales have reverted back to 2019 levels. So that's a little bit of a good positive sign for air freight demand compared to where we were in the back half of 22 and certainly 2023. If we talk possibly the best performing sector right now of wholesale trade is wholesalers of appliances, electrical equipment, and electronic goods. So this industry has sales right now, believe it or not, 40% above pre-COVID levels. And if you're asking yourself, how is this possible? The answer is a couple-fold. First, this is the sector that sells solar panels, and we've been putting in place more solar electricity than ever before. But also this would be the sector that a company like NVIDIA would fall in. And so this is a sector, since this includes semiconductor wholesalers, this is NVIDIA with its graphic processing units. So right now sales are doing phenomenally strong. You can see again this issue of excessive accumulation of inventories. We're now again back to pre-COVID inventory to sales ratios though. And then lastly, if we look at apparel wholesaling, you can see here that this is a sector where demand, again, crushed with the onset of the pandemic. It rebounded, but then fell sharply in 23, especially as consumers changed their spending patterns. And this was one of those sectors that built up way too much inventory, but they've, again, brought those inventories to sales ratios now back to where they were before COVID. And so the key thing here, with all of this is a lot of folks developed this, I'm going to call it restocking narrative in 23 and in 24. And it was this idea seemingly that we were going to see firms accumulate an abnormal amount of inventory again. And certainly that is not the intention. you can see this really strong center of gravity back towards pre-COVID levels for inventories to sales. Now, what we're looking at is potential tariff pull forward, but we have to wait and see what that is. And with that, Brian, it is back to you.
Thank you, Jason. Insightful as always. Great information. I love the explanation of the Inventory Accelerator versus the Bullwhip early on. I think that's something when you pitched that article to me a while back, it was something I wasn't really familiar with, and it's been very exciting to learn what that is and understand the differences there. So thank you very much for sharing that as well. Want to thank you for attending. We're just about out of time. I want to thank our sponsors, Blue Yonder, Coupa, Envista, and RFgen for helping Supply Chain Management Review put on this event. Our sponsors have been kind enough to make some additional resources available to you today, so please take a moment and download those for your dashboard at this time. Also, Jason is making a PDF of today's presentation available to download, so you can check out the information on your own time and dig into it a little further if you want. You can download that at this time as well. I'd like to thank our speaker for today, Jason Miller, for sharing his insights. For more insights like what you heard today, be sure to follow Jason on LinkedIn. I'm sure he'd appreciate some new connections, and it's really good content. I love it. And to all our attendees out there, thank you very much for watching. Have a great day.